Good morning and happy Sunday. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is August 11th, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about current financial market conditions. Specifically, when to be on offense and looking for opportunities, and also know when to be playing defense and protecting your capital. Asbury Research has been providing both investment research and money management to individual and professional investors since 2005. To get more information about us, visit asburyresearch.com, which is where we are at on your screen right now. Click the Contact tab. That is right underneath the About. So if you go to About and just basically hover your mouse over it, you don't need to click. You scroll down to Contact, and there will be a form there that you fill out with a little text box where you could ask a question or tell us why you've contacted us. You could also click the link in the description of this video and also get to us in that way. Finally, if these YouTube videos are useful to you, please like and subscribe. Let's begin with just a couple of brief announcements. Number one, Asbury Research launched its new website the beginning of last week. There's a lot of new wrinkles to this. One of them is there is a new asset management tab right here that displays several model portfolios that we have built with different levels of risk and reward by mixing and matching our data-driven models. Asbury Research is an RIA, a registered investment advisor. We can professionally trade and manage our CPM and CEF models for you, or a blend of those, which produces some interesting results as we backtest them. Contact us for details. We are also very close to launching a new and more affordable Substack newsletter. It's going to be over the next week or so. We will put some notifications out when that's ready, but if you're interested, the best way to contact us again is to go through the Contact tab and let us know you're interested, and we will let you know all of the details as soon as it's launched. Finally, I will be a guest analyst on Schwab Network's Morning Trade Live this upcoming Wednesday, August 14th. I'm going to be on about 9:15 in the morning, Chicago time, 10:15 in the morning, New York time. Now let's follow the money by identifying our key areas of focus as we look towards the fall and the upcoming presidential election. Number one, the Asbury 6 remains on a negative status as of July the 24th. You knew this if you listened to our previous Following the Money podcast, which was 4 days after that on July the 28th. The S&P 500 has declined by as much as 5.6% since we had that signal by the A6 on July the 24th. The Asbury 6, as we go to the Research Center and get over to the Asbury 6. The Asbury 6 is our daily risk management model that looks beyond the day-to-day volatility and noise of the stock market to determine its actual health. We view the A6 as kind of a lie detector for the market that helps our subscribers to identify real, sustainable market advances or declines from what we look as computer-driven traps for investors. What do I mean by that? How many times have you woken up in the morning and the S&P is down 50 or 60, even before the bell rings, according to futures? So you start moving money around your account because you're afraid that something bad's going to happen and we're starting a decline. Next thing you know, it's 1 o'clock in the afternoon and the S&P is up 50 or 60. The Asbury 6 day-to-day keeps us from making those emotionally driven mistakes by tracking 6 indicators that we have back-tested and found that they work very well together as sort of a team. We look at the rate of change in the S&P 500, relative performance between stocks and high-yield bonds, investor asset flows, volatility, trading volume, and market breadth. As a kind of a team, when 4 or more of them are red, that is negative. And what that tells us is now we're playing defense a little bit. We're not maybe taking some new positions. We're tightening stops on existing positions, maybe taking profits on some good trades that we had that we've had for a while, and we think it might be time to ring the cash register on those. You can see right now all 6 of these are negative. The numbers inside the cells are the actual dates that each of those constituents turn to negative or turn bearish. How do we get back to positive? 4 or more of these need to turn back to green. When that happens, there's a change in the signal, and then we start playing offense a little bit more than just trying to protect our position. Our CPM model, which is right here, we're not going to go in there just so we can keep the video relatively brief. But our CPM model, which is our defensive wealth management model, shifted to risk off a day later than the A6 on July the 25th. CPM is now outperforming the S&P 500 for the year, with almost half the S&P 500's maximum drawdown this year, which has been about 8.5%. What does maximum drawdown mean? It means from the very peak of where the S&P 500 got to this year to its lowest low following that. That high to low is the maximum drawdown. It's been 8.5% so far this year. In the CPM model, it's just about half of that. And again, we're outperforming now in CPM. What CPM is meant to do is to avoid drawdowns and then reallocate those assets lower once the CPM goes back to risk on. Over the past 7 or 8 years of back testing, it has stayed very close to the S&P 500, but with about half the risk. Why does that matter? Because especially if you're an older investor, if you're over 50, and the older you get, the more this becomes important. If the S&P 500 drops, like the maximum drawdown over the past 7 or 8 years in the S&P 500 has been 34%. In CPM, it's only been about 20%. Why does that matter? Because when you're older, and especially when you're starting to draw from your investment accounts, as you get older and you start to supplement your income with these accounts, you don't want the balance in there to drop low. You want to keep as much of that money in there as you can. And the second thing is, how long does it take for the recovery for you to get back to where you were before you had the drawdown, before you had the correction? During this the COVID decline, which was in the early part of 2020, it was like February to March of 2020 where the market really fell down hard. The recovery rate for the S&P 500 was 8 months. It took you 8 months to get back to before the drawdown started. In CPM, it was only 3%, or 3 months rather. It only took us 3 months to recover that. Why? Because we got out of the market before a lot of that decline happened, which allowed us to get back to even, so to speak, almost 3 times faster. So you could learn more about all of our models, including charts and back-tested performance, by visiting asburyresearch.com and going to the Models tab, which is right here on your screen. The next thing I want to look at with everybody is let's look at the S&P 500. Let's see where we are in terms of support and resistance and some important levels to look at. So here we've got the S&P 500 going back beginning of the year. It's going back to the beginning of the year. I'm redrawing a Fibonacci retracement grid here. Major support is right around, this is SPY. Let's give you a better look and look at the S&P 500, SPX. I think everyone's more familiar with those numbers. So here's SPX. Major support here. You can see I've got this rectangle showing a major buy zone here based on the 200-day moving average, which is this orange line here, the low that we made back in April, and then this important high that we made going all the way back here to 2022. So this is the buy zone. Let's call it 5,000 to 4,800. It's very broad, but that's where the major support is. The important resistance, we call it primary tactical resistance, is kind of our name for it, is right here where we've got a retracement level and the 50-day moving average right here in blue and the 21-day moving average right here in red. all coming about, let's call it 54.50. So as long as we stay under 54.50 in the upcoming days, in the upcoming weeks, let's say, we don't know how much farther down the market still has to go. That corrective period that we're in right now is still intact. So one place to watch on this chart, if I had to pick one, 54.50. As long as we stay underneath that, our CPM remains risk off, which is where it is now, and our Asbury 6 is 4 or more red constituents. We still are in a corrective mode, and the market is vulnerable to more downside. The next thing that we're going to look at is our CEF model. So we're going to change views again and go back to the Research Center. We're not going to go into the CEF model for today, try to save some time. But CEF and CPM are our two main models right now. We have variations of them that we're working on, but right now those two are the main models. CPM is your defensive model, and CEF is your alpha generating model. It's a sector rotation model that, according to our back testing, going back to 2018, has outperformed the S&P 500 by about 9%. If you're looking at annualized total return, with slightly less risk than the S&P 500. CEF is also outperforming SPX year to date. Make sure at the end of the video that you read all of the disclosures about back-tested performance. Back-tested performance is very important to us. That's how we build our models. This last 7 years going backward is a very good chunk of data to look at to try to backtest these models, backtest our own ideas, because it's included a zero interest rate policy. It's included a 100-year pandemic, COVID. We've had a major uptrend that was driven by Fed accommodation, and we had a major downtrend in 2022. So all these different characteristics of the market, it was a pretty robust place that 7 years back to try to see how our models work under various conditions. In our July the 28th Following the Money podcast, staying with the CEF theme, we said that the Utilities Select Sector Spider Fund was on a July 14th buy and overweight signal according to the CEF model. Let's take a look at that chart. We call these rainbow charts for obvious reasons. The rainbow up here is the daily ranking according to our CEF model. We have three different rankings. We have favored, which is green, and neutral, which is yellow, and avoid, which is the red one down here. And that tells us whether we want to overweight these models or overweight these sectors, or if we want to avoid them. So since July 14th, the CEF model had indicated the utility sector was on a favored status. And you can see since then, down here is the corresponding, and this is going back a year also, corresponding relative performance between XLU, which is the utility sector spider, the ETF, and SPY, which is the one that tracks the S&P 500. So since we had a CEF model overweight here on July the 14th, utilities has outperformed the S&P by 14%. You first heard of this on July the 28th, which was a couple of weeks ago, when we talked about this as a relatively new signal. It remains a positive signal going into next week. CEF also favors two additional sectors, again, via the Research Center. Asbury Research subscribers can get more information on these by just going to the Research Center and clicking on the CEF model. The last thing that I wanted to talk about is Asbury ETF trade ideas. Those are located here within the Research Center. Last week, and these ideas, by the way, there's 4 different technical criteria that we screen for. We screen thousands of ETFs, and we're looking for a positive trend, Relative performance versus the S&P 500. Outperformance versus the S&P 500 is what we're looking for. Specifically, we're looking for positive asset flows. That means there's positive AUM expansion in those ETFs. And finally, we're looking for an attractive risk-reward ratio. We usually don't like to get into a new position until we can identify a risk-reward of about 3 to 1. So we're risking 1 to make 3. Very important as a trader, and these are all trading ideas, shorter-term trading ideas, but as a trader, you want to make sure you know what your risk-reward is, because if it's 50-50, if it's 1 to 1, that means you have to be right more than 50% of the time just to make a small profit. Ours were right about 2/3 of the time, again, going back about 15 months, and our winners are about almost twice as big as our losers. So when you combine those, it comes up with a profitable system. In our July 28th Following the Money, we mentioned one of these ideas. One of the ETF selection model was long telecom, XTL. We're going to take a look at that here and see how we did on that. So here's XTL. So we originally put this idea on. I'm going to throw a relative performance window down in the bottom versus SPY. That's the blue window here, or the blue line. And this is XTL. This is daily going back to the beginning of the year. So we put our idea out right here on June the 4th. And we took a profit here, right here. So we actually made 9-10% on this idea. Why did we get out here? Because looking across this chart, we've got a lot of resistance based on these old highs that we made back in 2022. So once it struggled to get through this resistance level and it went back the other way, I was perfectly happy to take that 9%. And if we have a breakout here over the next couple of weeks, we could always buy it again. But just another rule that we follow here, if you've got a lead and you know you're at a resistance level and the market struggles to get through it, especially with the A6 that had recently turned negative and the CPM that had turned to risk off, this is the time that you really want to capitalize on these trades. Take your profit, and you could always go back into the market again. That's just kind of a rule that we follow here at Asbury. So finally, let's talk about the economic calendar. Just a couple of points so you're aware of them. The market is still very concerned about inflation. July PPI comes out this following Tuesday. Medium forecast for that is 0.2%. July core CPI. CPI is the consumer version of PPI. That comes out on Wednesday morning. Year-over-year median forecast for that is 3.2%. And finally, on Friday, we have July housing starts on Friday. The median forecast for that is 1.35 million. So there it is. Went through a lot of stuff this week. That's going to wrap up the Following the Money podcast for now. Our next Following the Money podcast is tentatively scheduled for Sunday, August the 25th. If you like our approach to investing, we can help you with either data-driven research or money management that implements my 40-plus years of experience in the financial markets and our own data-driven models that we continue to create new models. We'll have some new models for you in the weeks and months to come. You can request more information, of course, by going to Asbury Research and clicking the Contact tab. Hope to see you here again soon, and please don't forget to like and subscribe. Have a great Sunday.